Forex is the largest trading market in the world. In this video, you'll learn the importance of the FX market, the factors affecting it, and how to trade in the Forex market. So what is Forex? Put simply, Forex, also known as FX or foreign exchange, is the exchange of one currency for another at an agreed price. Forex trading involves speculating on the movement of exchange prices by buying one currency while simultaneously selling another. Currency values rise and fall against each other due to several economic, geopolitical, and technical factors. How do foreign exchange rates work? As currency exchange rates fluctuate all the time for a variety of factors, what Forex traders seek to do is profit from these fluctuations by speculating whether prices will rise or fall. All Forex pairs are quoted in terms of one currency versus another. Each currency could strengthen, appreciate, or weaken, depreciate. So for example, if you felt the pound would strengthen or appreciate against the US dollar, you'd go long or buy the pound-dollar Forex pair. You'd also buy if you felt the dollar would weaken or depreciate against the pound. Alternatively, if you felt the US dollar would strengthen against the pound or the pound would weaken against the US dollar, you'd sell or go short pound-dollar. What are some of the most important factors affecting currency exchange rates? The world of currencies is dominated by fundamental factors. Therefore, the strength of an economy determines the exchange rate of a local currency. Investors pay attention to macroeconomic releases and try to interpret the incoming data. This helps them assess the prospects of a given currency. Crucial economic data includes gross domestic product or GDP, industrial production, retail sales, employment data, inflation data, and survey data such as PMI, amongst others. Moreover, currency exchange rates tend to move depending on monetary conditions. As a result, FX investors pay a lot of attention to major central banks, since these institutions are responsible for conducting monetary policy. Why trade Forex CFDs? Forex CFDs are popular individual financial instruments by investors for a reason. Their popularity is due to a set of specific features of currency CFD trading. Number one, trading hours. It's said that the Forex market does not sleep because trading on it is possible 24 hours a day from Monday to Friday. Number two, easy availability. Usually investments are associated with a large expenditure of funds, the so-called high entry threshold. While to start trading on the Forex market, you generally require a lower amount of pounds, dollars, or euros, and no minimum deposit is needed. Number three, leverage. Forex CFDs, like most derivatives, have a built-in leverage. This means you only need a percentage of the full investment value to open a position. Low trading costs. With most Forex brokers, opening and maintaining an account is free, and commissions are free or low. The cost of opening an order in the Forex market may be a spread and/or a commission. High volatility. The Forex market is one of the most volatile markets in the world. However, high volatility might also be seen as a two-edged sword. That means that potential profits and losses may be much bigger. If you want to start trading Forex, get started on the XTB platform, either via desktop or the XTB app. Subscribe to XTB to learn more about trading and investing.